All right, Bismillahirrahmanirrahim. We have a question known as the paradigm. And again, first of all, let's go to the requirement. And the requirement is on the next page. The requirement is that prepare the consolidated statement of financial position, and it covers your 20 marks. You have the full consolidation question. All right, so you have on 1st October 20x2, Paradigm acquired 75% of the Strata's equity shares by means of a share exchange of 2 new shares in Paradigm for every 5 shares acquired in Strata. And I told you that in the exam, you will always be having the share exchange, most probably in the consolidation question. Okay, so we acquired 75% of the shares, and by means of share exchange for 2 new shares in Paradigm for every 5 shares acquired. Okay, so if you see the total number of shares of the subsidiary, if you go to the balance sheet, is 20,000 is the balance, and $1 is the shares you have. So that means 20,000 shares into 75%. Okay, that gives you, I guess, 15,000. Let's work out, multiply 0.75. Yeah, it gives you 15,000. Okay, 15,000 is the number of shares acquired. So on 1st October 2002, Paradigm acquired 75% of the equity share. That means we have 15,000 shares by means of a share exchange of 2 new shares in Paradigm for every 5 shares acquired. So multiply by 2, divide by 5. This is the fraction we have. Paradigm issued the shareholders of Strata a $100 10% loan note for every 1,000 shares acquired. Then we have another thing, loan notes. Okay. Paradigm has not recorded any of the purchase consideration, although it does have other 10% loan notes already in issue. The market value of the Paradigm shares at 1st October was $2 each. So first of all, we multiply it by $2. It gives you 15,000 into 2, divide by 5 into $2. Okay, what happened? 15,000 into 2, divide by 5. This gives you 6,000, multiply by 2, 12,000. Okay, so let's pass the double entry. The double entry is debit cost of investment by total 12,000, credit share capital by par. Okay, so which is 6,000, and because it is issued at $2 above the par value, so the other half is the share premium. Then you have the 10% loan note. Okay, so Paradigm issued to the shareholders of the Strata a $100 10% loan note for every 1,000 shares acquired. Fine, we have acquired 15,000 shares. So for every 1,000 shares, we issued a $100 loan note. Simply we can calculate that. So 15,000 divided by 1,000 into $100. So it gives you 1,500. So this is the consideration, 12,000 and 1,500. The summarized statement of financial position of the two companies at 31st March are, okay, now we can go to the Excel sheet. So you have this Excel sheet in front of you. Fine. Let's just zoom it out in order, oh no, it's too much. Okay, I guess now it's fine. A bit more. Now it's fine, yes. So first of all, you have the loan note. Okay, we are having the balance of the loan note of 1,500. We have calculated it. Let's put it over here, 1,500. Then you have the share exchange, which was 12,000. So we have already put that in the consideration, right? Now let's go to the rest of the question. Okay, you have the property, plant, equipment, financial asset, which there's not one given in that. Then you have the current assets, inventory, trade receivables, bank total assets, and then you have the equity shares. Then you have the retained earnings. Okay, retained earning at first April 20x2, which was the loss, and you acquired the shares at 1st October 20x2. So that means that the retained earning at acquisition is not given to you. So you need to calculate it. You need to calculate it. Fine. So you have the retained earnings at 1st April 20x2, which is the start of the year, and then we have the for the year ended 31st March 20x3. If you add these two, that gives you the retained earnings at the reporting date. Then you have the non-current liabilities. Then you have the 10% loan notes, which is other than you have issued. Then you have the current liabilities in the trade payables, bank, and this. Okay, the following information is relevant. At the date of acquisition, Strata produced a draft statement of profit or loss, which showed it had a net profit, a net loss of 2 million at that date. Okay, this has been given to you in order to calculate the retained earning at acquisition. Because if you remember the mid-year acquisition, we said there are two ways to calculate the retained earning at acquisition. The first way is that you can take the retained earning at start of the year and then work out till acquisition, or take the retained earning at the reporting date and again work out till the acquisition. So we can do both ways. Paradigm accepted this figure as the basis of calculating the pre and post acquisition split of the Strata's profit for the year ended 31st March 20x3. Okay, fine. Also, at the date of acquisition, Paradigm conducted a fair value exercise of the Strata's net assets, which were equal to their carrying amounts, including the Strata's financial asset equity instrument, with an exception of item of plant, which had a fair value of 3 million below its carrying amount. So this is the fair value adjustments of the Strata's net assets, and the plant had a remaining economic life of 3 years. So if you remember, we said that when you have the upward fair value adjustment, we add it and the depreciation is deducted. Here we have the opposite. We have the downward revaluation, that means will be deducted, and the extra depreciation which has been charged will be added back. Paradigm policies to value the non-controlling interest at the fair value, and for this purpose, the share price of the Strata should be used. Okay, the total number of shares the subsidiary was having was 20,000. We acquired 75%. That means the 25% belongs to the NCI, which gives the 15,000, and the fair value of the NCI is 1.20. So 15,000 into 1.20 gives you 18,000, which is the value of the non-controlling interest at acquisition. Each month since acquisition, Paradigm sales to Strata were consistently 4.6 million. Paradigm had, okay, each month since acquisition. So if you see, we acquired the subsidiary at 1st October 20x2 and the year end 31st March 20x3. So how many months? October, November, December, January, February, March, 6 months. So each month it was 4.6 million, right? So 4.6 into 6. So that gives you 27.6 million, the total sales of the 6 months. Paradigm had marked these up by 15% on cost. Fine. Strata had 1 month supply, which is of these goods in inventory. Paradigm's normal markup to the third party customer is the 40%. Okay. So that means you need to calculate the value. So this 4.6 million is still in the stock, which represents 120%. And we need 20%, which is, oh, sorry, it's 15. This is 115. And we need to calculate the 15%, which is in the profit. Okay, so it's 4,600 divide by 115 and multiply by 15. So it gives you the 600. So unrealized profit is 600. This has been sold by Paradigm Sales to Strata, so it will be deducted from the working number 5 and from the group inventory. Strata's current account balance with Paradigm was 2.8 million. We need to eliminate this simply by debiting payables 2800 and crediting the receivables by 2800, which did not agree with the Paradigm's equivalent receivable due to a payment of 9 lakh made by Strata, which was not received. Again, we did in the last question as well. This is the cash in transit, so debit cash 900 and credit receivables by 900. The financial asset equity investment of Paradigm and Strata carried at their fair values. As at 31st March, these fair values was 7.1 million and 3.9 million respectively. So if you go back, you see the fair financial asset was 7,500 of the parent and 3,200 of the subsidiary. So there is adjustments in it. At the year end, it is carried at 7.1 million and 3.9 million. That means there is a revaluation. So the subsidiaries adjustment will go to the subsidiaries working, and the parent adjustment go to the parents. So there were no impairment losses. Now we will be making the consolidated statement of financial position. All right, so now we have read the complete question, and now we can just plot the figures into the Excel sheet. Okay. So let's go back to the Excel sheet. We have already plotted the loan note of the 1500. And let's just zoom it in. Okay. All right, so we have the loan note of, now let's put the working number 1. The share capital was 20,000, if you remember. So that will remain the same, 20,000. There was no share premium. Retained earnings. So this is a very important point you need to focus on, and let's discuss it in detail. If you see, we acquired the subsidiary on 1st October 20x2, which is a mid-year acquisition because the year end is 31st March and it started at 1st April 20x2. And we acquired the subsidiary on 1st October 20x2, which is midway. From 1st October 20x2 till 31st March, these are 6 months. And in the retained earning of the subsidiary, you can see we have the retained earning at the start of the year, which was 4,000. And then we have the full year profit of 8,000. Now let's come back to the note number 1. He said, at the date of acquisition, Strata, at the date of acquisition means on 1st October. Strata produced a draft statement of profit or loss, subsidiary prepared it, which showed it had made a net loss after tax of 2 million at that date. So the net loss is 2 million. Paradigm accepted this figure as the basis of calculating pre and post acquisition split of the Strata's profit. So they were already having a loss of 4,000 and they calculated the loss of further 2 million. That means on acquisition, there was a loss of 6,000 because 4,000 the previous one and then further 2,000. Okay, then. So now we are done till the 1st October. On 1st October, they were having the loss of 2 million plus the 4-month previous one. Now the whole year profit was, for year ended 31st March 20x3, the whole year profit was 8,000. So that means we already have calculated till acquisition. So this 8,000 belongs to the 12 months. We can have the 6 months profit, which will be 4,000. So, or you can say this is calculated as retained earning at start of the year plus the whole year profit, 8,000 plus 4,000, which gives you again 4,000 as well. If you add these two, it will give you the same. So the retained earning at reporting date is 4,000 because there was a loss of 4,000 at 1st April. Then At also the date of acquisition, Paradigm conducted a fair value exercise, which were equal to their carrying amounts. We already started with the exception of the item which had a carrying value of 3 million below its carrying amount. So that means 3,000 we'll less that from the acquisition date, and we're going to less 3,000 from the reporting date. Okay, the plant had a remaining life of 3 years, so 3,000 divided by 3, which gives you 1,000. 3,000 is actually the value which is below the carrying amount. That means the depreciation of 1,000 per year has charged extra. So we have the 6 months calculation. So divide by 12, multiply 6. So 500 depreciation has been charged extra because they have charged it on the full amount rather than on the fair value. So we're going to add back the 500 depreciation at the reporting date. Okay, fine. We are done with that. Now we have already calculated the NCI value, which is, yes, sorry, this is wrong. The 20,000 shares, there were total 20,000 shares of the subsidiary, and the 25% is 5,000. We just wrote it wrongly, 15,000. Multiply by 1.20, it gives you 6,000. So the value of the NCI at the acquisition is 6,000. We can put it over here. Fine. So now, okay, now we have the loan notes. We have the share exchange. Yes, we are done with that. We can also calculate the net assets at acquisition simply by dragging it. It gives you 11,000. So minus 11,000 from here. Now we can calculate the goodwill simply. It's 8,500. There is no impairment, so we can directly put this goodwill over here. 8,500. Okay. Then you have each month since acquisition Paradigm sales was this. Okay, we have already calculated the unrealized profit, which was 600. So this has been sold by parent to subsidiary. So we're going to deduct that from the working number 5. So the unrealized profit was minus 600. Then you have the current balance of 2,800, and then you have the cash in transit. We'll be adjusting that in the current assets. Then the financial asset, which is shown in the balance sheet, if you see, the financial asset of the parent was 7,500 and it was 3,200. Now it is 7,100 and 3,900. 7,100 and 3,900. That means the subsidiary has a profit gain on that of 700, and the parent has a loss which is 400. So the parent loss belongs to working number 5, so we're going to deduct 400 from here, and that 700 belongs to the subsidiary, which we will be adding that in the reporting date. So now we can also have this finalized. So it is 22,200. So 22,200 minus this, it gives you 11,200. So 11,200 into 0.75 will be distributed to the parent, which is 8,400, and 11,200 into 0.25, which is for the NCI. So 2,800 for the NCI. So let's add it. First of all, the NCI value at acquisition was 6,000, and the post acquisition share is 2,800. We can finalize it now. it gives you 8800. Then you have, okay, the parents gain, which was 8400. The unrealized profit, we already put that, which was 600. Other losses were 400. The retained earning of the parent, let's go to the balance sheet, it was 19,200 plus 7,400. So it's 19,200 plus 7,400. It gives you 26,600. So 26,600. There's no impairment, there's no unwinding, there's no acquisition cost, there's no associate. So now we can finalize it. It gives you 34,000. Okay. Now all the workings have been finalized. Let's go to the property, plant and equipment. Okay, so the property, plant and equipment, the parent's property, plant and equipment, it is 47,400 plus 25,500. So 47,400 and plus 25,500 minus 3,000, which was the carrying value, fair value below the carrying amount, and plus 500, the depreciation impact. So it gives you 70,400. Okay. The financial assets, okay, investments, financial asset, it was 7,100, which is the new value, plus 3,900, which is again the new value at reporting date. It gives you 11,000. Then you have the inventory. Let's go back to the inventory. Inventory was 17,400. Okay, and add the subsidiaries inventory, which was 8,400, and minus unrealized profit, which was 600. Trade receivables, parent trade receivable, which was 14,800. Add the subsidiaries one, which is 9,000. Then you're gonna deduct the intra-group, okay, intra-group, which was 2,800, and then you're gonna deduct the cash in transit, which was 900. So it gives you 20,100. Then the bank of the parent, it is 5,100. Subsidiaries one is nil, but you have the cash in transit of 900. So we're gonna add the 900 into it. So that now you can calculate the total assets. It gives you 1,41,200. Okay. Then you have the equity shares of the parent, which is 40,000, but this 40,000 will be added with the new shares, which is share exchange, the capital one. So it will be 40,000 plus 6,000, sorry, is 46,000, and the rest is the share premium, which is 6,000. The retained earning we have already calculated from working number 5 is 34,000. Okay, we don't have other reserves in it. Let's leave it. Then we have the liabilities, loan notes, which were, if you see, 8,000 plus the issuance of new loan notes, which were 1,500, because those were not recorded. So 8,000 plus 1,500. So it gives you 9,500. Then you have the trade payables. Okay, it is 17,600 plus 13,000. 17,600 plus 13,000 and minus the which the intra group, which was 2,800. Yes. Okay, we don't have the contingent or the deferred consideration. We have the bank overdraft of only 9,100. We missed the NCI, which is 8,800 from working number 4. Now we have calculated the complete thing, hopefully. Yes, let's total it. It is 1,41,200, and you can see this is reconciled. Okay, so this was the question paradigm. Now you can solve it by yourself, and I'm putting the Excel file into the folder as well as the video.